Good evening, I'm Steven Van Metre, and thank you for joining us tonight as we discuss the biggest topic of the day, the outcome of the Federal Reserve meeting. Now, I've seen the headlines following it. This is the Fed's turn dovish. The Fed's put a floor under the market. The Fed's going to ease. The Fed's dumping liquidity in the market. And all I ask myself is, what press conference were they listening to? So tonight, in 15 minutes or less, we're going to break down the entire Fed meeting. I'm going to show you exactly all the stuff, and you can form your own opinion. But since I'm not sure we can do it in 15 minutes or less, we've got to get started quick. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. The material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in my own personal capacity. The opinions expressed video or that of my own do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. Advisory services offered by Atlas Financial Advisors, Inc., a registered investment advisory firm. All right, so with that, Kimberly, Susan, thank you for joining me. Here's how we're going to do it. I'm going to take you to the Federal Reserve website, and I'm going to go through with you exactly what they had to say. Then I'm going to go through my notes from the press conference. I'll show you where that video is, and then we'll see how the market reacted and what really is going to happen after the fact. All right, so let's zip over, if I can do this correctly, to the internet, and we need to switch some tabs here. All right, there we go. So now I'm on the Federal Reserve website, federalreserve.gov, and conveniently they've got a link to the video. So if you want to watch the 47-minute press conference and you have some free time and you want to learn some stuff, that's a good place to look. All right, so let's start first with the Fomc statement, and let's break this down together. So it says the information received since the FOMC met in December indicates that the labor market has continued to strengthen and the economic activity has been rising at a solid rate. Job gains have been strong on average in recent months, and the unemployment rate has remained low. Now, what the Fed is saying here is, look, one of our goals is to maintain full employment, which is an absurd goal because they can't actually achieve it given their toolbox. But so far they're saying, hey, everything from that standpoint looks good. Keep that in mind of how many things look good to the Fed, okay? Put your eyes, or put your mind in the view of the central banker. Household spending has continued to grow strongly. I'm not sure about that. While growth of business fixed investment has moderated from its rapid pace earlier last year. On a 12-month basis, both overall inflation and inflation for items other than food and energy remain near 2%. Now, the key part here is the 2% because the Fed's goal is to make prices go up at 2% a year so they can print as much money, even though they technically cannot print money, but that's kind of what they're trying to do is expand the monetary base. But they want us to only feel the effects of 2% increase. And they're saying, hey, that's exactly what the data is telling us. We are at our 2% target. So far we're at full employment and we have 2% target and decent spending. Okay, so we've got some good stuff from the Fed's view. Although market-based measures of inflation compensation have moved lower in recent months. Now, what are they talking about here? They're saying, look, Wall Street's in a tizzy. They're saying inflation is going down. Okay, now, mind you, the Fed's saying, look, we're seeing our 2% target, and we're listening to Wall Street over here saying, all right, we hear you. You're saying there's some concerns, so let's go on. And then they say survey-based measures. Now, survey is what the Fed does. They go out and they survey businesses of longer-term inflation expectations or little change. So on one side, the Fed's saying, all right, we hear you, Wall Street. And on the other side, they're saying, yeah, but that's not what businesses are actually saying. So far you get the impression that the Fed thinks Wall Street is a little bit nervous. All right, so let's go on. Consistent with the statutory mandatory to foster maximum employment and price stability. Yeah, tell me about that. I've looked at prices of cars and stuff like that lately. I do not see price stability at all. The committee has maintained the federal funds rate at 2.25% to 2.5%. So what did I predict? I predicted the Fed would not make a change. And this was an easy one. I didn't even have to show up the ball game to win that guess. The Fed raised rates in December, and the current Fed started raising rates in December 2015. So they generally are raising rates about 2.5 times a year, and they never make a move immediately after a move. They usually wait about 3 to 6 months, okay? So keep that in mind. There's no way they're going to raise rates at this meeting. Not a chance. The committee continues to view sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective as the most likely outcomes. In translation, we think everything is A-okay. We don't see a recession coming. We don't see any of the problems that Wall Street is saying. In light of global economic and financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target rate for federal funds rate may be appropriate to support these outcomes. All right, now this is where everyone's misinterpreting things. The Fed's saying, look, we hear you, Wall Street. We hear you. We also hear businesses over here saying, nah, everything's okay. And so they're a little concerned that maybe Wall Street's right. So all they're saying is, hey, why don't we just be patient? We weren't going to hike anyways. We'll just see what happens. Now, their next meeting's not until March, and then there's some time. So they're just saying, hey, let's just leave things alone for now. Okay. So nothing panicking going on here. In determining the timing and size of future adjustments to the target rate for federal funds, the committee will assess realized and expected economic conditions relative to its maximum employment objective and its inflation objective. This will take in a wide range of information. So essentially they're saying, we'll just hang tight and see what happens and adjust later. So now we've gone over the Fomc statement, and what you get from this is nothing changed. Nothing. So all this excitement about, oh, the Fed's going to do something, you don't see it there. So let's do a little more digging. All right. There's nothing interesting in that one. Balance sheet normalization. All right. This is where all the excitement's going on. A lot of people are talking about the balance sheet, and we'll get into this in a few minutes of why the Fed really doesn't want people talking about it. But we need to know what their opinion is, because going into this meeting, the assumption was the Fed would stop doing their $50 billion a month balance sheet unwind or go back to quantitative easing. No. But let's look. All right, so let's skip down to here where it says all participants agreed. The committee intends to continue to implement monetary policy in a regime in which an ample supply of reserves, they're referring to bank reserves, ensures that control over the level of the federal funds rate and other short-term interest rates is exercised primarily through the setting of the Federal Reserve administrative rates, yes, in which active management of supply of reserves is required. This is a key part right here because the Fed has been very clear. Our primary tool is the federal funds rate. This other stuff we did, we had to do it. It was an emergency situation, folks. Great financial crisis. Our primary tool is the federal funds rate, not the balance sheet. So keep that in mind. So let's go on. It says the committee continues to view changes in the target range of the federal funds rate as its primary means of adjusting the stance of monetary policy. The committee is prepared to adjust any of the details for completing balance sheet normalization in light of economic and financial developments. Moreover, the committee would be prepared, notice, would be prepared to use its full range of tools, including altering the size and composition of its balance sheet, if future economic conditions were to warrant a more accommodative monetary policy than can be achieved by reducing the federal funds rate. Now, let me translate this for you. If the federal funds rate has to go back to zero because there's another recession and that doesn't fix the problem, we will consider doing something else. That is all you read there. There's nothing else that says anything else. It says, number one, we will adjust the federal funds rate. Number two, if that doesn't work, then we'll go back and review this balance sheet thing. Okay? Doesn't mean they won't stop it if they go to zero, but you see nothing about stopping or expanding there. All right, so now we have to go do some more digging to find out what else is going on. And we have to dig into the calendar here, and we have to go to the Fomc meetings. And let's see, where was this before? I looked this up right before we started, and I just realized I don't remember. Oh, here. It was under the calendar. There we go. I was like, where did I hide that? So this was buried, and I was looking for this during during the announcement because this is the only thing I cared about. My prediction, again, was no federal funds rate increase, no change to the balance sheet. That was my prediction. So let's look. All right. Let's see. All right. Now they're talking about their system open market account, which is the people who manage all of their balance sheet internally. The committee directs the desk to continue rolling over at auction. So these are the Treasury auctions that go on pretty much every week. The amount of principal payments from the Federal Reserve's holdings of Treasury securities maturing during each calendar month that exceeds $30 billion. So what they're saying right here is, look, continue unwinding U.S. Treasury bonds not to exceed $30 billion and continue reinvesting in agency and mortgage-backed securities in the amount of principal payments from the Federal Reserve's holding of agency debt and agency mortgage-backed securities. There we go. We'll say, highlight that. Received during each calendar month that exceeds $20 billion. Small deviations are acceptable. Now, let me translate that. They didn't change anything. So we're still doing $50 billion a month. $50 billion, February, March. There will be no change until the end of March meeting. None. Zip, zilch, not going to happen unless something really goes wrong. So what did the Fed do? Nothing. They did nothing because they didn't need to do anything. They're looking back and saying everything's A-okay. So now you know exactly what's going on with the Fed. And so now we've got 4 minutes. So real quick, I want to touch on what was said at the meeting that I thought was important. The Fed blamed the slowdown in the fourth quarter of last year due to the government shutdown. And they said the bad data from that should clear out by second quarter. So what are they already telling us? Look, all this stuff that you all think is bad, Wall Street over here, it's going to go away soon. We just need to be patient. Okay? They reiterated the balance sheet would only come back into play in terms of, say, a quantitative easing. They didn't say this, but he did say it. Not that direct, but he did say it after the federal funds rate would go back to zero, which he thought would be sufficient should this ever happen again. In fact, Jerome Powell, the Fed chair, said, I don't see us having to do quantitative easing again. Oh my. No sign of recession. I'm sorry, but I think this is hilarious. They're so in denial about their situation. So the next Fed meeting is on March 19th. The announcement will be March 20th, so don't expect anything to change until then. They were asked about, are we at the neutral rate? The Fed said, yes, we are at the low end of the neutral rate, and we expect that as the government shutdown ends and people go back to work and get paid and get caught up and spend, that things will be back to normal by the second quarter. They did feel the policy stance of the current federal funds rate and the balance sheet unwind was appropriate, and he mentioned that they never intended to have two active policy tools running simultaneously, and because of that, there's all of a sudden excitement from Wall Street and investors about the balance sheet unwind, and there should be, because the Fed did quantitative easing to support asset prices, and now they're unwinding it. So that means stock markets should be going down more than it should be going up. And so they said, we're going to provide a little more clarification, because apparently telling you that we are going to start at 10 billion in 20, 30, 40 and hold at 50 billion until we get down to some lower level that's much lower than now but higher than it was in 2008 is not good enough for all of you. So we're going to come out with a little more clarity, so that way you can forget about it, because really the Fed does not want any attention on this balance sheet at all. They want it to be on autopilot, they want it to be in the background, and they don't want you thinking about it. So let's go look at a chart really quick, because that's all we have time for. And here you can see, here's the S&P 500 kind of jumping off from December. Everyone's excited, the rally's back. And in this purple that I'm going to mouse over so you can see it a little clearer is 10-year Treasury yields. And in the short run, 10-year Treasury yields and stock market run together. But you'll notice 10-year Treasury yields are headed lower. And what that implies is either the stock market should be under its 50-day moving average in green and below the technical support level of 2,600, or yields should be rising. So what is actually going on? Well, there is an answer to that. as well, and we can go back to the web browser and take a quick look for fun. If I can get over there, there we go. Here's marketwatch.com. We can look at 10-year treasury rates. During the Asian markets, they're at 2.681. So the question then is, well, interest rates are, pointing lower, but what about, are they going to go higher, or is the market going lower? Well, we have to look at the biggest owner of U.S. Treasury bonds, the commercial banks, who own 2.7 trillion. The answer to the question is the stock market is wrong. Bonds are telling us exactly where the market's headed. So bonds are going to lead the market down. I'm probably going to write about this next Friday, not this coming Friday, but the following Friday. I think I'll go over that in a little more detail. So that's our update in 15 minutes on the Federal Reserve. If you want to watch the video from them, I encourage you. Again, it's about 47 minutes long, but believe me, you'll know more than most people, and you can cut through also fake news about how the Fed is now easing, because clearly they're not. So I'm Steve Van Metre. I'll be back with you on Friday for our weekly economic update. Hope you enjoyed tonight's video. We'll see you in 2 days. Bye now.